All right, welcome back. Procter & Gamble is one of the top performing consumer staple stocks over the past year. It's up more than 40%. Barclays goes in big time today. They say the best is yet to come. The analyst upgrades it to an overweight rating, raises the price target to $112. We made it our call of the day. Brenda, you own it, and boy, they are positive. They say, we think many are starting to question if this is the best it can get. Simply stated, we don't think. You don't either.
Yeah, we own the stock. We're going to continue owning the stock. I think it's important to have consumer staples as part of a diversified allocation. But nevertheless, this stock is up tremendously. It's trading at almost 24 times PE. This analyst is arguing for further multiple expansion, despite the positive tone. But I would say, that being said, they did just have a tremendous quarter. So organic growth is beating expectations. That's tremendous. But nevertheless, we would have a little bit of caution here. Still like the company, but would it be loading the boat here? Not right now.
Yeah. I mean, a lot of these staples stocks, if we've learned recently, Pete, have pricing power.
Right.
They're protecting their margins by raising prices.
Yeah, and that was one of the things I was going to point out is the fact that when you look at what the analyst report shows here, they see margins hanging in there, Scott, pretty good, somewhere between 49, 49.5, something like that. And they talked about how great the reach is globally and how broad it was in terms of just being an even keel in terms of how much they were doing everywhere. But they really focus on they are killing it here in the U.S. And because of that, this is their biggest market still. So I think it's a very positive sign. Now, I agree with you from a cautionary perspective. Trading 24 times. Yeah. If you're willing to hold on.
Have they gotten too expensive? A lot of these staples.
Five turns to the sector. I agree with Brenda. I mean, it's 5 multiple points ahead of the sector. It's great, but is it that great?
Yeah. This is organic sales, to your point, Brenda. That was one of the things that stood out to me in the call. Organic sales were up 20%. You don't see too many companies at this scale, at this size, with an organic sales growth of 20%. But that's what they said, and yet they still hit it yesterday, Scott, because they just barely beat on both sales as well as profits. And I think the market just said the run has been so furious, and to your point, Siege, 5 points over the rest of the market. They said, let's lighten up here, and people followed them in the lightening up.
Should this valuation be in the same zip code as Alphabet? Absolutely not. It's crazy. You need to see the market move up substantially for me to justify this valuation. They're still growing at 10%. It's ridiculous. So it may be a defensive stock or a defensive company. It's not a defensive stock. This is an offensive stock. In other words, you're betting on this to really get a new valuation paradigm.
Well, staples have been a good place to play offense.
They have been, but that's going to end. At my point, in terms of, I'm not looking for a big decline here because they've been executing and doing some of the right things. And if it's steady in perpetuity, this growth level, that's fine. You want to own it because it's very predictable. That's why it's got the money.
We're telling you right here at the bottom of the screen, staples sector hits highest level since February of 18. And a good place to be.
No question.
Why get off the train now?
I think it's got different growth characteristics than some of the other sectors, maybe different valuation characteristics than some of the other sectors, and that's why it's probably a pause. I think I don't want to put words in Brenda's mouth, but if she had new money to put to work, I think she'd pace it in this sector, even though she probably likes the stock.
And I'm not saying sell it. I'm just saying I wouldn't buy it.
I hear you.
Outside of fundamentals, though, I think one of the other drivers of the sector, as well as other higher yielding sectors within the S&P, has been the yield curve flattening so much. So there's been a lot of money going into REITs, consumer staples, utilities.
The dividend.
Because of the dividend yield. So I think if we did get a scenario where global growth started to improve, the yield curve started to steepen a little bit, that could take some money could rotate out of the sector.
That's a great point. You're going to see a rotation out of rate sensitive equities because of tail hedging.
We start to see it.
You're already seeing it. That's right. Yeah, I think those are vulnerable because if you're going to take your interest rate risk, you're going to take it in the fixed income market.